You want to live off your dividends on your dividend account? I'm going to tell you how I do it, and hopefully it helps somebody out there. This is Mike, the Tactical Stock Scalper. All right. So, yeah, the goal when we retire is to pull dividends and live off them. There's certain funds you just can't do that with, but there are some that you can. And so averaging down, or DCA, whatever you want to call it, is so important in this process, to me at least. And let me tell you why and how I do it, right? I buy off levels on the chart of the underlying of whatever that I am invested in, okay? And that really helps. And I always buy lower than my cost basis. Now, I know there's some people that buy above their cost basis, and maybe living off dividends isn't as important to them, or maybe they just have a different methodology. But for me, it is super, super important, okay? So how do I do it? Well, obviously I use EMAs. If you ever follow my content, you know I use EMAs to average down at levels on the chart. And so we had a dip this week, and I saw a lot of panic and people selling out of positions. What am I doing? I'm buying. Okay? I'm buying so that when the price goes up, it gets above my cost basis. Okay? And then when the dividends come, I can pull them. Why can I do that? Because it's above my cost basis. I don't need to reinvest them back in to keep the share price stable. That's really important to me. And so by averaging down on the chart at levels, it gives you this ability. Now, does it guarantee a bounce when you average down at levels? No, nothing in a market is guaranteed, but it gives you your best shot rather than just averaging down because it's red, right? I'm waiting for it to drop down to a particular level, go in then with an allotment instead of nibbling here, nibbling there. I go in with the allotment at a level, bringing my average price down. Then when it goes up, it gets above my average price most times, and then I can pull the dividends. Now, I'm not pulling the dividends right now because we're not retired, so I don't need the money currently that's in my high yield account, but I will when I retire. So right now I'm just in the building phase, accumulation phase, if you will. So, but I still practice the same methodologies. And if you're a trader, you're going to have a huge advantage. If you're a trader and come into these funds, you're going to have a huge advantage to do this over other people because you understand technical analysis already. Okay? So that's why having this trading background I have found has really helped me with these funds. I understand technical analysis. I understand levels that a stock could potentially bounce. Now today, I bought YMAX, BYT, bought Amazon, AMZY, a bunch yesterday, pre-earnings, with anticipation of, with an earnings call of them going up. And then the market rising today with Jay Powell. Now, did I know 100% sure that there would be a great earnings from Amazon? No, I thought there would be, but I wasn't 100% sure. So what would have happened if it had been bad earnings? I would have waited, bought more at a point on the chart where it could potentially bounce in the future. But I anticipated possibly having good earnings. Now, AMZ, for instance, way above my cost basis. So even when the dividends come out next week, even with those dividends, it'll still be above my cost basis. So if I had to, if I was retired, I could pull those dividends, no problem, because the stock is above my cost basis. Same thing with SVOL, well above my cost basis. And we got dividend from those, like yesterday or today, still above my cost basis. So I could have pulled SVOL, and that's all because I averaged down on the chart. Now, stocks like FEPI, ETFs rather, like FEPI, SPY-T, and YMAX, and SVOL provide you with a wonderful dip buy opportunity because they rise so fast as the market is going back up. And they can get above your cost basis, so you can do that. Now, things like IWMY, QQQY, JEPB with the Y, they don't allow you that potential because they're capped and they constantly go down, right? Even as the stock market is rising, they will go down over time because their dividends are so huge. So those have to be played, and for me, and the methodology is a little bit different how I pull those dividends, right? But still, you can still pull some even with those high dividends and the share price of those particular ETFs going down, because they do get capped because of the puts that they sell. You can still do it. You can still pull half of them, potentially, if you average down at levels on the chart. Because even though they're capped, as the market goes up, those ETFs still will go up. That's just it. They will. Not to the level of FEPI, SVOL, or SPY-T, or YMAX, but they will. So what I love about the other four, FEPI, SPY-T, SVOL, and YMAX, for people like me that buy at levels, they provide great dip buy opportunities because they will go up as the markets go up. So for me, someone that's a trader, those are very, very important for me because I have so much confidence that I can dip buy those, and then as they go up, I can pull 100% of the dividends. Now, you may be asking me, Mike, what's going to happen in a bear market, or this or that, or a long corrective measure that could last 2 to 3 months? I would still average down on those continually, getting my average price lower at levels because the markets always go up over time. Always, always, always go up over time. Now, could they have prolonged periods of like a year, 2 or 3 years of going down? Sure, they absolutely can. But over time, they will go up. So I have no problem dip buying those heavily, more so than I do some of my other funds. I hope this helps somebody out there and shows the importance of DCAing and how imperative it can be to your plan by dip buying on levels on the charts to help you pull your dividends. Hope you enjoyed the content. This is Mike, the Tactical Stock Scout, out.